It's time for the Phil Ferguson Show. This is Phil Ferguson, and you are listening to the cleverly titled The Phil Ferguson Show. What freaking number? 409. Let's call this 409. The pre-recorded segments, the skeptically investing stuff coming up. Got a couple of fun topics. One is a refresher follow-up on Treasury inflation-protected securities tips, and also iBonds. So if you were looking for a place to hedge against inflation without a whole lot of risk, maybe the iBonds would be better for you, but that's not something you can get on through a mutual fund. You have to go to treasurydirect.gov to buy those, and it's all talked about in that segment. So if you had questions about tips or iBonds, I'm going to go over those. And the other thing, the long promised from several weeks ago, 16-year performance calculations on a couple of different investment strategies and how they work and how well they did and things like that. Keep in mind, and I may have to do a separately special segment, none of that includes any tax consequences. So the couple of accounts that have a couple of strategies that have more regular adjustments, if you're in a taxable account, you might have incurred more taxes along the way as things get rebalanced or moved around. So something to keep an eye on when you're balancing or rebalancing. Keep an eye on taxes in a taxable account. You don't want a big, nasty surprise. Although a lot of it, quite frankly, the long-term gains, if you're buying and holding stock or stock funds or stock index funds, for most people, the tax tier is going to be 15%, which honestly, I think that's a deal. But whatever. That's just me. Other things that I'm doing, I am continuing to go on my adventure with Charles Schwab. As regular listeners know, Charles Schwab bought TD Ameritrade, oh my God, what is it, 2 years ago now? And thankfully, it has kind of worked quite well. And as I hypothesized a long time ago, the advisors, people like me and their clients, people like some of the listeners, we're going to be late to the game as far as something that Schwab is going to handle, because it's not generally a big money-making part of a brokerage firm. They make more money on banking and trading and some other activities and services that they sell, not advised clients that I might adjust a couple of times a year in small amounts, at least with my strategy. But we're getting closer. Last I told you probably second or third quarter of 2023. So we're still a full year out. But what I decided, what I would like to do is I don't want to be amongst the 10,000 advisors that switch from TD Ameritrade to Schwab over a period of weeks, probably months, maybe even a good part of a year. So I wanted to try to prep myself in advance to know and understand the Schwab system. And I'm kind of glad that I'm doing that, and I'm kind of not glad that I'm doing that, because part of the onboarding process for the advisor to Schwab, I've had to go through some training. And it's one of those things that it's nice because I'm learning new things. It's also frustrating because I have to learn new things. But it also is very revealing because I've been at TD Ameritrade long enough that it doesn't seem that complicated, but it is. There's a lot of things. There's one of the ongoing jokes I have is there's a form for that. There's a form for everything. And I know most of those forms at TD Ameritrade. What Schwab, when I look at the list of forms, it looks bewilderingly huge, the number of forms that there are. And, you know, I'll get used to them too. That's fine. There's some things that are different that, and almost all of this, I'm assuming, it's just something that's different. And so sometimes humans, me included, we don't like different. here we are. One of the things that stuck out to me is at Schwab, they call what I would call traditional IRA or IRA without any other qualifier like Roth or rollover or beneficiary. An IRA is an IRA unless you add some other word to it. But to be safe, you could add traditional. You could even get wacky and get traditional deductible IRA. Well, at Schwab, they don't use those words. They call it a contributory IRA, which it's not wrong. But who does that? Nobody does that. Schwab does that. So that's something I'll have to get used to seeing on forms and telling people when they're filling out a new IRA account application, a traditional IRA account, that it doesn't say traditional IRA on the form. It says contributory IRA, which means you can add money to it. So, cool. It's not wrong, just different. I got to get used to it. And they have a whole different system for submitting documents and things that are required for me as the advisor to be fully set up so that I can start having clients there at Schwab. And some of the systems and processes are a little wonky. And again, it's just different. It's new, so I'm not used to it. But one thing that I did like about TD Ameritrade's online system is that I could always go back to the home page or my starting page quite easily. And there were menus that always appeared at the top, whereas in Schwab, sometimes those top menus disappear and you have to hit an exit or a back button on the page you're working on to kind of go back to where you were. But that button is in different locations on different web pages. Just a small thing that hopefully they'll fix it. Something nice that Schwab has that TD Ameritrade doesn't have as good, and they're probably not going to in the next year, is Schwab has a thing called digital onboarding. And so if you're already a client, with Schwab and using Phil as your advisor, Polaris Financial Planning, and you want to open a new account, I can go through what they call digital onboarding for a lot of account types, but this is a newer thing, so not everything is there, but a lot of the regular accounts. So let's say you already have a contributory IRA. Now you want a Roth IRA. Well, with a few clicks, it can populate all of the information that is available from your already existing IRA, put it into the Roth IRA form, and then it sends you an envelope of documents to your email address securely and codified that you can open up and respond to. And hopefully between me and you, opening the account is even easier than it was before, which was honestly not that hard. But another thing is I had to open up a brokerage account for Polaris, and Schwab is very used to, and the team that helps the advisors is very used to opening up individual joint tenants, IRAs, Roth IRAs, that kind of stuff. But when it came to a corporate account for Polaris, it got a little confused and I had to find a different team to talk to. And the form in total was 30 pages long, and with a lot of forms in the line of work that I do, a lot of them, there's entire pages you can skip. And it had an example here where there's the first person, the first owner, and then the second owner and the third. So I filled out the part for me as the owner of Polaris, and it had 7, 8 other pages for other owners in case there were multiple owners. So they were just redundant pages that I had to skip, which is great. But then to sign the form, and this drives people nuts, I know, dear listeners and my clients and friends, I then had to print it, all of it, sign it, and then scan it back in, which clearly is a waste of time and paper. But that form is not in the magical process yet of digital onboarding. So we'll get there. But overall, their system so far looks good. There's some pluses and there's some minuses. And they have already incorporated a few things that the TD Ameritrade advisor page had that are new to Schwab. So it's just going to keep getting better. At least that's my expectation. And of course, that's what they've been telling me. And as I've said before many times, the things that they're telling me, they're actually doing so far. So that's great. At this point, I'm not looking for anyone else to transition to Schwab. So just chill. You're in a good place at TD Ameritrade. It's owned by Schwab, so it's not too much of a difference. Another fun thing that I'm doing right now is I'm listening to Thomas Paine. You may have heard of him. He had a couple of famous books and or pamphlets. The first one was on Common Sense. Thomas Paine really jacked up the locals in the colonial days, pre-Revolutionary War, to get everyone to understand the benefit of America, the 13 colonies, the United States, to become its own separate self-governed entity. And that was quite short and really, really an easy read, or in my case, listen to, because it was an audiobook. And now we're going on to me. I'm listening to the next part, which is about his thoughts on religion. And damn, he rips up religion cold. I mean, it's beautiful. It's something to behold. So high marks so far and everything I've heard. Can really strongly recommend getting something from Thomas Paine to either read, check it out at the library, get an audiobook, whatever. You're going to like it. But that's enough for an intro. We're going to go into the investing skeptically stuff, and I'll see you on the other side.
Hey, poor! You don't have to be poor anymore! Jesus is here!
Section 1. The Origin of the Bible. A few wandering families, poor, wretched, without education, art, or power, descendants of those who had been enslaved for 400 years, ignorant as the inhabitants of Central Africa, had just escaped from their masters to the desert of Sinai. Their leader was Moses, a man who had been raised in the family of Pharaoh and had been taught the law and mythology of Egypt. For the purpose of controlling his followers, he pretended that he was instructed and assisted by Jehovah, the God of these wanderers. Everything that happened was attributed to the interference of this God. Moses declared that he met this God face to face, that on Sinai's top from the hands of this God he had received the tables of stone on which, by the finger of this God, the 10 Commandments had been written, and that in addition to this, Jehovah had made known the sacrifices and ceremonies that were pleasing to him, and the laws by which the people should be governed. At that time these wanderers had no commerce with other nations. They had no written language. They could neither read nor write. They had no means by which they could make this revelation known to other nations. And so it remained buried in the jargon of a few ignorant, impoverished, and unknown tribes for more than 2,000 years. Many centuries after Moses the leader was dead, many centuries after all his followers had passed away, the Pentateuch was written, the work of many writers, and to give it force and authority, it was claimed that Moses was the author. We now know that the Pentateuch was not written by Moses. Towns are mentioned that were not in existence when Moses lived. Money, not coined until centuries after his death, is mentioned. So many of the laws were not applicable to wanderers on the desert. Laws about agriculture, about the sacrifice of oxen, sheep, and doves, about the weaving of cloth, about ornaments of gold and silver, about the cultivation of land, about harvest, about the threshing of grain, about houses and temples, about cities of refuge, and about many other subjects of no possible application to a few starving wanderers over the sands and rocks.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Phil Ferguson Show.
This Investing Skeptically segment, I guess I'm going to call it 16-year performance. How's that sound? About 6 years ago? What did it be? 7 years ago? Anyway, I first did this as 10-year performance, and I took the numbers that I knew, because getting numbers older than 10 years as just an individual or, a small company can be pretty hard, because that data gets to be expensive. You have to buy it from somewhere. But I had the 10-year-old data 6-7 years ago, and I did this 10-year performance. And then each year, I just added new data to it. And so now this is the 16-year performance. And if you really wanted to, you could go dig back through all the years and find all of the old performances. So it's a bit of an update on that. And the idea and what it does is it compares 4 different ways of investing in retirement. And one way, the most simplest way, and probably will be the biggest winner and won't surprise hardly anybody, is just putting all of your money in the Vanguard Total Stock Market Index and letting it roll. And all of these, by the way, there's 4 different ways. Let me actually just do the 4 different ways. Total Stock Market Index, that's one way. Second way is Vanguard's Target Date Fund 2015, because again, when I started this around 2015, 2016, we were assuming someone was in retirement, so that's mode 2. Mode 3 is called the three-legged stool, and it is the Total Bond Index, Total International Index, and the U.S. Total Stock Market again, like the other one, but they're in a fixed percentage. Total bonds is 30%, international is 20%, and U.S. stock market is 50%. And the fourth one is kind of sort of the Polaris plan, keeping in mind in 2006, I didn't have as robust of a plan, as complicated of a plan, and some of the funds that I use today weren't available, or some of the funds I used back then were different. As an example, many years ago, I did have some money in intermediate and long-term bonds, and so I tried to create best I could without being too crafty, too foxy, too clever for my own good, and put what I actually was doing in 2006 best that I could remember 10 years later in 2016. So keep in mind, I created this. It is handmade. It's custom designed. And I could be tricking myself. I could be tricking you with the results. I had the ability, and I still have the ability, to change numbers and make choices that might make me look better at some point in the past or some point in the future. And it's just for discussion purposes. No one had this exact situation in this exact portfolio over those years. Again, it's just to review the basics of it. So starting on January 1st of 2006, and one of the reasons 10 years seemed really nice to me back in 15 or 16, whenever I did this first, was that I was going to start when the stock market was doing well and not after it bottomed out. Because if you start at the beginning of 2009, the market just lost 37%, and it's all upside, baby. And you can make stocks look way better than they really look. I also didn't really want to start at the beginning of 08, because then it would make stocks look a whole lot worse than they could, because you lost 37% in the first year. So I went back a couple years to have average years. Not that they ever exist, but it's 06, 07, then the big drop. And so at the time I made it, the 10-year look back had a huge drop near the beginning, not at the beginning and not before the beginning. So I'm trying to not bias too greatly in that regard. But of course, we've now had since 08, 09 through 2021, basically up market the whole way. Yes, there's one year where it was down maybe 4%. And when I say market, I mean US, and I probably also mean S&P 500, which is not actually the market, but that's another story. So the story is someone is about to retire or retired in 2006. Like everybody, they're worried about running out of money. And we started with the 5% rule. So this person has $1 million, this theoretical person has $1 million, and they want to take out 5% or about $50,000. And so far, we've gone forward on the assumption that they will continue to take $50,000 every year. And while I could probably take hours going over the details in this, I want to get to the end. And the end is the end of the year 2021. And I'm going to go over the results of what you have. And 3 of them, then the amount you take out is going to be very easy. And then the 4th one, which is the Polaris plan, gets complicated. But let me start with the target date fund. It's very simple. It's very simple. You just put all your money in the 2015 target date fund, and at the end of the year, you take out $50,000. It's nice. It's easy. Now, if you heard a show or two ago, I was talking about the U.S. stock market in some parts was up 25, 26, maybe even 28%, depending on how you look at it. The target date fund has U.S. stocks, it has international, and it has bonds, domestic and international. It has all kinds of stuff, but you can't go in there with I like to say, with a scalpel and decide which parts to sell based on the last 1 or 2 or 3 years of market activity. It is what it is. Vanguard does what they do. And when you take 50 grand out, you take 50 grand out across the board on the winners and the losers, and you have no way to control it. So regular listeners will know I like to say target date funds are suboptimal. It does not mean that I hate them. And in some cases, they may be the best investment choice you have available. If you have a 401k or a 403b with a lot of high expense ratio funds, buying a target date 10, 20, 30 years out into the future based on the date of the target date fund may be your best choice. In this case, the fund returned 5.78%. The big reason for that low performance, below 6%, even though the S&P 500 is up 28, is because the vast majority of this fund is bonds. Vanguard takes these funds and they are relatively conservative. If you have a big down year in stocks, domestic and international, you will be delighted to have a fund like this. It provides a pretty good amount of protection, maybe too much protection because it always comes with a cost. But in the last 16 years, this fund has gone from 1 million. It is now at the end of 2021, 1.236 million. So you have a larger portfolio than you did 16 years ago, even with taking out $50,000 a year. Now, most research data suggests that when someone retires or when a couple retires and they start taking out money, that's generally the amount of money they're going to keep taking out every year, and it doesn't go up. With inflation, you could argue that it does go up some, but again, this simplified scenario just sticks with the $50,000. So in this case, you could take out 50 grand a year, about 5% of the original money. After 16 years, you have slightly over 1.2 million. Not bad, and a lot of protection, and it's simple as fuck. You just put it in the 2015 fund. If you want to make it relatively well protected and simple as hell, you might consider a target date fund that is 5 to 10 years further out than your retirement date. So if you're retiring, let's say 2016, instead of getting the 2015 fund, you might want to get the 2020 fund or the 2025 fund. That's just an opinion on my part because I think Vanguard makes these too conservative, too much in bonds. But, it's something for you to think about, something for you to consider. If you want to do it really, really simplistically, in this scenario, you're still money ahead. The next one I'm going to look at is what is often known as the three-legged stool. And again, we started with $1 million. 300,000 or 30% was in bonds. 200,000 or 20% was international. And 500,000 or 50% is in the U.S. stock market. Of course, you could have a different mix. You could change the mix. But for the purposes of this long-term examination, what I did was at the end of each year, did a hard rebalance back to those percentages, 30% bonds, 20% international, 50% U.S. If some or all of your money is in a taxable account, you might have more tax consequences with this than the target date fund. Keeping in mind, in the target date fund, Vanguard will be buying and selling things. They will be adjusting different parts of the portfolio, and it's not super tax efficient, but it's pretty good because it's a collection of index funds. And here you have 3 different index funds: total bonds, total international, total U.S. but you're going to have probably more adjusting that you're going to do. And so if it's in a taxable account, you might have slightly higher tax consequences. But the interesting thing is for this calendar year, 2021, the results were considerably better than the target date fund. The target date fund made 5.78. This made 14.08. I'm just going to call it 14%. 14% is a very nice return. So nothing to complain about there. You can, you don't really, in this one, you don't really pick and choose what you take out. You're just automatically rebalancing. So in the process of rebalancing, you rebalance your cash position from 0 to 50. So you just create a simple Excel formula and it will tell you what to take out. If it's in an IRA or a Roth IRA, really easy to do. Not as easy as the target date fund, but the performance is quite a bit better. And over our 16 years here, we've gone from 1 million to 1.8 million. So the target date fund was 1.2. The three-legged stool is 1.8. Why did the three-legged stool do so much better? Mostly because it has a lot more stocks. The target date fund might have 50% or 40% stocks when we started, but Vanguard keeps increasing that. And I think that fund is now 60+% in bonds. And the target date fund is still going to be hard forced to 30% in bonds. So instead of 1.2, you made 1.8. So an extra 600,000 by taking risk. How will this do in the next few years in a down market? Not predicting a down market, mind you. I'm just theoreticizing if there's a down market, which one will do better? Probably the target date fund because it's mostly bonds. But, 1.8 million, if you lost a third of that, or about $600,000, you'd only be down to where the target date fund already is. So sometimes it's best to make the most you can make in up years, because even if you lose the most in the down years, you're still ahead. Just a side thing to think about. The next one, which is the top performer, beating out the Polaris plan by quite a bit. Let's look at the total stock market index. And again, it's phenomenally easy. You have 100% of your money in the total U.S. stock market. You have no adjustments between international and domestic. You don't even have any international. You don't have any bonds. And this fund is going to be volatile. And this year it was volatile in a positive way because it's up 25.71%. Let's call it 26. You made a lot of money. And it's really easy to figure out what money to take out. You just sell $50,000 of this portfolio in any given year. This was, of course, we started in 2006. So you had 6 and 7, which were up, and 8 was the year that it lost 37%. But since then, the market's been up. So this portfolio has made a lot of money. This is one of the reasons I tell people that if you are 15 years or more out from retirement, stocks. Because even if you do lose a lot of money in the short run, and it's happened to people before, and it's happened multiple times over the years and the decades, but odds are in your favor that if the way you want to make the most money, the best way to make the most money is stocks. But keep in mind, you have to be able to stomach the volatility. And in this case, someone in retirement with this $2.7 million portfolio, if the market lost a third, they're going to lose about $1 million, at least in the short run. So that's a big loss. Will you be psychologically prepared to handle that? The interesting thing, of course, is if it goes from 2.7 to 1.7, it's done almost as well as the three-legged stool, and it still beat the target date fund after losing $1 million. So that's the long-term value of having stocks. But a great performer this year, 26% positive. Again, you're still taking out $50,000, which is now way below 5%. And I have not done any adjusting in these calculations where if you have several good years in a row, you could tweak up the amount you're taking out. It would stay the same as a percentage, but it would no longer be 50,000. It might be 52 or 55, or in this case, close to 100,000 or even more than 100,000. And of course, as you get older, You can probably take out more than 5%. You could go to 6% in your late 60s, 7% somewhere in your 70s, and maybe even higher in your 80s, just because the number of years you're going to take money out decreases as you age. Life expectancy, it's not the best thing to talk about, but it's real, so we have to address it. And now the most complicated thing. That's the Polaris plan. We've talked about it before, and it slowly shifts and morphs through the years. But again, this is set up for someone who is actively in retirement, so it's relatively conservative, at least compared to a 100% stock portfolio. And it's kind of like the three-legged stool, but it's more like the 18-legged stool. And it gives you lots of opportunities of where to sell. And I think that adds a whole lot of value. So let's look at some of the specific performers we've talked about already this year. The REIT fund went up 40.4%. So I took a big chunk of money out of there. The U.S. parts, 26%, 25%, 28%. The small cap growth actually only made 6%. So I rebalanced money back into there. And again, this is fantastic and easy if part of your money is in IRAs or Roth IRAs. You might have some of your money in taxable accounts, and depending on the specifics of what you have where and what your tax situation is, it might be better to sell things that have appreciated a lot that are in the taxable account, because you might pay 0, 15, or 20% tax on the gains, or it might be in your best interest if you are 59 and a half or older to sell from the IRA, again, depending on which things you want to sell. And it might be a mix. And this is a good reason, another good reason to have a tax professional help you with this kind of stuff. You can sit with them, pay them a little bit of money and say, where should I take the money from? What are the tax consequences now and in the future by making different choices? This collective fund for calendar year 2017 made 16%. And you might think, but Phil, the stock market, yes, the U.S. stock market made 28. International is closer to 10, 8 maybe even. So that's a big drag, because I'm pushing 25% now towards 30% in international. So if a third or 30% of your stocks make 8% in a year and the other 2/3 make 28%, your results are going to be a lot lower. Also, this portfolio does have a generous portion. It started originally with 30% in bonds. And it's a tricky thing. You can always calculate what percentage your portfolio is in bonds, but I'm not creating the size based on the percentage of the portfolio. The size of the cushion is based on how much cash flow you need. So in this case, now at the end of 2021, the part of the portfolio that's the cushion is $392,000. And you might say, "Whoa, Phil, if it was now the total portfolio here for the Polaris plan is over $2 million. If it's 30%, shouldn't it be $600,000 in the cushion?" No, because you're still only taking out $50,000. So the stock dividends, the domestic stocks, the international stocks, and the bonds that you have are paying dividends. How much do you need in the cushion to meet your annual requirement? Now, as talked about briefly in some of the other examples, the other ways of investing, if you increase the dollar amount that you're taking out from 50,000 to 60 to 80 to 100,000, you would have to consider rebalancing, selling some of your stocks, domestic and international, and increasing the size of the cushion to provide you the protection or the number of years of protection that I seek from the cushion. So that could change what you want to do as well. But again, in this overly simplified, we started taking out 50 grand and we decided that was enough. And so every year going forward, we took out 50 grand. That portfolio is now 2.2 million. So it is not the 2.7 million of being all in stocks, but it's way better than the 1.8 of the three-legged stool and way better than the 1.2 from just having a target date fund. So this fund is now $2.2 million. So there's some examples. The stocks, not surprisingly, straight up stocks did the best. If there is a big correction, might the Polaris plan catch up and pass it? That's unlikely. I think that's really unlikely because of the cushion. So, the cushion is small. It's 25, 30% in this scenario. So if the market falls, there's still a lot of stock to be exposed to the downside. So it's not like the Polaris plan is going to lose 5% when the market goes down 30. It might lose 20% or 22% for someone in retirement. If you're 15 years or more from retirement and you're 100% stocks and stocks fall 30%, you're going to lose 30%. That's easy. But with some cushion, if the market goes down 30, maybe you lose 20, maybe you lose 22. You're still going to lose a lot. But the nice thing about something like the Polaris plan, where you have that, what I call the clarity and the granularity, if the market, U.S. stock market and international stocks all fall 30%, you can go and just sell the bonds. You're not selling any stocks at a loss. With the U.S. stock market only, you're selling stocks at a loss. You have no choice. That's all you have. You've done well. So it's not really that big of a problem, but it could be if you have 2 or 3 years of down market like we had after the dot-com crisis in late 90s, early 2000. The target date fund is mostly bonds already, at least the 2015 target date fund, but you can't control what part you're selling. So some of what you're selling will be stocks. Some of what you're selling will be bonds. The three-legged stool, you could break one of the legs, I guess, as a metaphor, maybe gone too far, and sell only bonds and reduce your bond portion. But the original rules we set up for that were that it gets hard adjusted every year back to fixed percentages. So just recap in current dollar values. Target date 2015 fund went from 1 million to 1.2. The three-legged stool went from 1 million to 1.8. The Polaris plan went from 1 million to 2.2, and stocks only went to 2.7. So there's some numbers. So it works either way in this scenario. If we get a big down year, it'd be interesting to see what the effects will be. But again, when you're looking long term, the way to make the most money is, again, stocks. That's just what they do. So hopefully that helps you think about, frame some different ways of investing in retirement and how to balance out risk versus returns. And that ends the 16-year performance.
It is now not only admitted by intelligent and honest theologians that Moses was not the author of the Pentateuch, but they all admit that no one knows who the authors were, or who wrote any of these books, or a chapter, or a line. We know that the books were not written in the same generation, that they were not all written by one person, that they are filled with mistakes and contradictions. It is also admitted that Joshua did not write the book that bears his name, because it refers to events that did not happen until long after his death. No one knows or pretends to know the author of Judges. All we know is that it was written centuries after all the judges had ceased to exist. No one knows the author of Ruth, nor of 1st and 2nd Samuel. All we know is that Samuel did not write the books that bear his name. In the 25th chapter of 1 Samuel is an account of the raising of Samuel by the witch of Endor. No one knows the author of 1st and 2nd Kings, or 1st and 2nd Chronicles. All we know is that these books are of no value. We know that the Psalms were not written by David. In the Psalms, the captivity is spoken of, and that did not happen until about 500 years after David slept with his fathers. We know that Solomon did not write the Proverbs or the Song, that Isaiah was not the author of the book that bears his name, that no one knows the author of Job, Ecclesiastes, or Esther, or of any book in the Old Testament with the exception of Ezra. We know that God is not mentioned or in any way referred to in the book of Esther. We know, too, that the book is cruel, absurd, and impossible. God is not mentioned in the Song of Solomon, the best book in the Old Testament. And we know that Ecclesiastes was written by an unbeliever. We know, too, that the Jews themselves had not decided as to what books were inspired or authentic until the 2nd century after Christ. We know that the idea of inspiration was of slow growth and that the inspiration was determined by those who had certain ends to accomplish.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. This Investing Skeptically segment is a follow-up on inflation-adjusted bonds. I'm going to talk about two different types. They're similar in a lot of ways and, of course, not similar in some other ways. They are TIPS, Treasury Inflation-Protected Securities, and iBonds. It seems like they're kind of the same thing, but there's some little nuances and little differences. I feel like I need to talk about it because I've gotten several emails in the last few days and I haven't talked about them for a while. So let's just do a brief summary of what they are and how they might help. The one thing that we should probably know is both types of bonds, the TIPS and the iBonds, can be bought directly at a website called treasurydirect.gov. There are limits on how much you can buy. I think it's $10,000 for the iBonds. So that's the most you can buy in a year. There's also some rules about when you file your taxes, you can get some more, and you can dig into that if you want. The thing that's real sexy right now is that the government has released that the composite rate on current iBond issues is 7.12%, which is a lot. So when you're looking out at other bonds that might pay 1 or 2%, looking at something like this that pays 7%, and it's a U.S. Treasury bond issued by the U.S. Treasury. A couple of caveats. Once you buy them, you may not sell them for the first calendar year. So not the calendar year, for the first 12 months, for the first year that you own them. After that, up to 5 years, if you sell them, there is a penalty. And I believe that is 3 months of interest. But it might be a way for you to put some of your money aside that's relatively protected from inflation because the composite rate changes and it's announced every 6 months. And it can go up and down, and it's added to the base rate of the bonds. The problem is that the current base rate is 0. So you get 0 as a base plus the inflation adjustment, which I said right now for the next couple of months is 7.12%. Keeping in mind that that rate added to the base changes every 6 months. If inflation stays high, you win. You keep getting relatively high bond yields. If inflation goes down, the rate that you are getting paid can decrease dramatically. So I'm looking back here through time. As an example, in May of 2015, the inflation rate for the next 6 months was minus 0.8%. And if I go back to May of 2009, for that 6 month period, the adjusted rate was minus 2.78. So just something to keep in mind. What are you going to get? You know, it depends. It varies. Over the last 20 years or so, mostly the rate has been 1%, 2%, give or take. And that was because interest rates or inflation was really low. If we go back to a point of really low inflation, you might be in a position where you get the base rate of 0 with the added rate of 0.5% or 1% or 2%. Again, that sounds nice compared to a lot of the bonds that are available today. But if interest rates go up, you might be able to go out and buy bond funds, even with U.S. Treasuries that pay 1.5% to 3%, and maybe 4 or 5% if we start looking at intermediate and long-term bonds. Not today, but after interest rates go up. So money tied up here is, if inflation goes back to normal ranges, your returns might be 0.5% or 1% or 1.5%, where you could buy a long-term bond, U.S. Treasury bond, that might pay 3.5%, 4.5%, 5%, or getting up in historical numbers 6 or 7, which I don't see likely in the near future. But being in a bond that pays 1 or 2%, but protected from inflation, to you might sound better than making 3 or 4%. So just something to think about. That's iBonds. And again, you have to go to treasurydirect.gov. That is the only way to buy them. You are buying them from the government. And when you want to turn them in, you have to turn them into the government. And you'll have to follow the process, which is probably going to involve you going to a bank and having them help you with a form and sending the bonds in and waiting for the government to respond. So this is not something that you can just go online and click and get your money back. It probably will take weeks, maybe a couple of months to turn them back in. But if inflation stays high, this is a nice thing. One possible downside on this, if you're a client of mine or some other advisor, they can't help you buy them. You must go to Treasury Direct to buy them. Again, and the annual limit is $10,000 with some caveats and exceptions, which you can read at the Treasury Direct website. So there's something you might want to kick around. I mean, if you've got $1 million portfolio, $10,000 of iBonds seems like a small amount, but if it's worth the extra little effort for you, give it a kick. I don't really see a whole lot of downside, other than you might be locked into something really close to 0 to 1% for the next 30 years. Keep it in mind, after 5 years, you can sell them back to the government with no penalty. So if you think inflation is going to be high for the next 2 or 3 years, check them out. That's iBonds at Treasury Direct. The other type of bond that I mentioned, also available through Treasury Direct and in limited quantities. Again, I think, up to 10,000. Is that right? Hang on a second here. Oh, rats. I can't confirm that on the Treasury Direct. It may not have that $10,000 limit, and they're also traded on the market, so you could go and buy them on the market. They work very similarly to iBonds in some ways. One big difference is you can get 5, 10, or 30-year TIPS, Treasury inflation protected securities. And sometimes they have, I think, a base interest rate that is negative, unlike iBonds. So you might be locked into a negative rate. Of course, you can sell them on the market. There are Treasury inflation protected security index funds. As a reference, of course, Vanguard has one. The current yield on that is minus 1.7%. So if inflation goes to 1%, you might make 1% from the inflation adjustment, but lose 1.7% because of the base yield on those bonds. So they're not as protective, I think, from a negative effect as iBonds are, but they are more easily available because you can go, like I said, to somebody like Vanguard and buy them. One of the things that I worry about is because they are tradable, because there's a market for them, they might react differently depending on the changes in conditions. They might respond differently than iBonds respond, because for the iBonds, it's between you and the government. You can hold the bond, you can sell the bond back. Those are basically your choices. With TIPS, you can buy them and then trade them on the market. You can buy them in a fund. And if the market, if the majority of the people in the market think that inflation is going to be rising, the prices of TIPS can go up because they can buy them from you on the market and get perhaps a older bond that has a higher base interest rate and still get the inflation protection. So they're willing to pay a little bit more for those. However, this is important. If inflation goes away and you have TIPS that pay a base rate of negative 2%, the interest that you get, the face value of the bond, can actually go down based on the calculations from the government. But if you want to sell it, it might go down even more than that. Because if, let's say you have a 30-year TIPS bond, who wants to buy that bond from you for 30 years if the locked-in base rate is minus 2%? And someone else thinks inflation is going to be 1 or 2%. So they're going to buy the bond for basically face value, or $100, $1,000, whatever amount you have, or something less than that. So these have a little bit more market risk, and sometimes I think even more, a larger effect on a TIPS bond fund might be the perception of where inflation is going to be. So if you have a bunch of those and people think inflation is going to go up, you can make quite a lot of money by selling the TIPS that you own to someone who's more worried about inflation than you are. On the other hand, if you buy Treasury inflation protected securities or inside of an index fund and the expectation for inflation goes down, you could lose a considerable amount of money. And I'm not talking anything crazy, but -5, maybe -10% if there's a big snap where people think that inflation is going to go away. So just some thoughts about those. Both types of the bonds are available at treasurydirect.gov. The TIPS can be bought in funds, index funds, but do try to understand a little bit about the risks, particularly on the TIPS. If you want something that's pretty much a no-brainer, the iBonds are a nice way to go, but again, limited to $10,000, where the TIPS are not limited to $10,000. So that's some information about inflation-protected bonds from the U.S. government.
You're listening to The Phil Ferguson Show.
Buongiorno. Come stai? How you doing? Welcome back. I'm glad you're still here listening. I guess you're not even welcome back. You just didn't stop the podcast, which means you're still listening, and I thank you very much for listening. And, of course, all of the endless kind comments and 5-star reviews at multiple places. I thank you very much for all of that. Of course, if you were a Patreon before, thank you for that. I think that's almost nobody's left. If you're still on patreon.com, which is fine, I don't have a problem with it. If you're contributing to me, I'm not collecting anything, and I will soon shut that page down. But it's maybe a dozen or 2 people left out of hundreds. So thank you all for moving, and hopefully you found the podcast somewhere else because you're listening now. It's the middle of winter here in the Chicagoland area, and thankfully we're not that close to the lake, because apparently we're going to get a nice, interesting winter weather pattern where the wind blows west across the lake, and the people who are too close to the water are going to get 6 to 8 inches dumped on them today from lake effect snow. We had a dusting, maybe half an inch, maybe a full inch overnight. Not too bad. It'll melt away in a day or two. So things are going well here. I'm waiting for spring to come. Another fun thing that I am doing right now, not that you care, but I'm going to tell you anyway, I'm building a Lego set. I like Legos. They're kind of fun. They're kind of pricey. And then, of course, the big problem is once you build something, where the fuck do you put it? But I am building, what do they call it? Diagonally. It's a Harry Potter set, little buildings of a certain scale. And it's kind of fun and lots of colors. And it's one of those weird things when I'm doing Legos, I'm not thinking about everything else. I'm just thinking about the Legos. I'm thinking about the design and the creativity and the artistry and the engineering, the fact that someone had to figure out how this gets built and which pieces to use, and the beautiful artwork that shows you what pieces to put where, and of course the simple process of actually building something, because it's one of those things that I'm not particularly good at fixing, repairing, building things, and while my main skill set of helping people make money is very valuable, I'm excited about that. I don't have anything I can really point to say that I made it, except for maybe some Lego stuff. So I don't know. Maybe that's the attraction. I'm kind of like Forrest Gump on the lawnmower. Actually, that's the other thing. When I mow my lawn, there is nothing else. What else is there? Of course, there's taxes. It's tax season, not just for me, but for all of my clients. So there's things that have to be done there. There's all the new information I'm learning from Schwab. I mentioned that at the beginning. I had to go through a training to learn their system and processes, and there's videos to watch, documents to read, pamphlets to review. Probably 10 to 20 hours I've put in on that in the last month or so. So that's taken up a good chunk of time, but it's all for the greater good. And of course, I think I've mentioned this. I created a pension pension plan for Polaris and all of its employees, me. And boy, was that fucking complicated. The documents that I had to sign and review and double check for errors was about 300 pages. 300 pages of documents. The vast majority of it I understood. Some parts I did not. I had to investigate and learn new things again. I don't think I've learned so much in a week since maybe grad school. I don't know. It was a lot of stuff to review and a lot of stuff to learn, a lot of complex and interrelated things, but I'm pretty sure it's done. I may have a thing or two to double check, but Polaris now has a pension plan. If you have a small business, if you didn't know it, you can have your own pension plan. And the ideal thing for the one that I set up, it's called a cash balance plan. If you are, say, for example, a doctor or chiropractor, dentist, an attorney, whatever business you have where it's maybe just you as the owner or 2 or 3 people as the owners, and you might have either no employees or a dozen employees, and it's easier and cheaper to do if the employees are younger, which maybe is not as cool as it should be, but there's a possibility if you have excess income coming in and you don't know what to do with it and you don't want to put it in a taxable account, setting up a pension, while difficult and complicated, could allow you, business owner, depending on your age, and the older you are, the more you could put in, you could possibly save for yourself and not pay taxes on $200,000 to $300,000 per year. It is insane. It should not be legal, and but it is. So, kind of as a fiduciary responsibility, it is my place to tell you that that is an option. You should go investigate it. If you want to talk to me about how I did it and how I set it up, I'm perfectly happy to do that. And of course, it goes into a pension plan. When you retire, it rolls over to an IRA. And when you take the money out, you do pay all the taxes on it. So it's not like it's magic. It's just taxes delayed, taxes deferred, and you get to have the growth and the compounding on the higher dollar amount while cutting taxes, hopefully at the peak of your earning income, in your 50s or early 60s, and you can put away a lot of money. And then when you retire and might make the same or you might make less, the money you're pulling out has a lower tax rate, maybe, because it depends on what Congress does. And all of the games here could become meaningless if they vote to change a rule. So something to think about if you have your own business. Again, you can let me know. If you have other ideas for show topics, let me know. You can email me, phil@polarisfinancialplanning.com. I already have an interview for next week. It's for someone who found their way out of religion. I like doing those from time to time. And I think I'll just wrap it up here. And that's all for today's show. I appreciate you listening. And I'm going to the American Atheist Convention for Easter weekend in Atlanta. I hope to see you there. Until then, ciao.